freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Adam, what's happening today?
Just enjoying the calm before the storm out here in California, which is funny because there's actually a storm where you are in Tennessee, but it is nice right now, and in the summers we get to like 110. So
yeah, I can't. We get some rough humidity here for a month or two. I can't deal with that like desert type temperatures. You guys have extremes. I mean, it gets cold too, right?
Yeah, I mean 20. We don't get snow at the valley floor, but it'll get down to 20. We'll get a hard freeze once or twice a year.
Okay, well, okay, so it gets colder here. I still couldn't deal with that level of heat. That's not.
A lot of time inside.
Today I've got my tropical shirt, so
I see that. And you're heading to Orlando this week.
I am not sure when this will air, but yeah, heading to Orlando for a collective meetup.
Well, whenever it airs, you got to head to Orlando.
Okay. I guess I'll just go back and see Mickey Mouse or something. I don't know. Yeah.
Anyway.
Well, you had a good idea for this week's episode, a topic, and something I don't think we've talked about this before, but it's good and applicable. So kick us off. Tee us up with what you got.
Well, we were chatting about a deal that I was doing, and earlier today we had an offer not accepted, but we're a backup offer on an apartment building, and it was primarily because we were beat out on price. There were maybe a few other factors in the terms, but the biggest thing was price, and that's what most sellers are looking for. And I said, well, if we'd gone up $400,000, $500,000, I think we would be in contract right now. But same thing with the flip that we were kind of spurred this discussion is there's a whole lot of meat on the bones. There's a lot of profit to be made, but the profit, if you look at it, and we kind of I did a little thing on a spreadsheet. I'm like, if we take the rehab budget and double it, there's still profit. But if I just add a lot of, let's just say put it at market value for the purchase, or maybe a little above market value, what I think it would have gone for on a public market on the MLS, then I don't know if that value would have been there, right? So a lot of the value is created when you purchase it, and that might lead to you or investors getting less deals, but we get less deals under contract, but those deals, the offers we're writing are at the value that we think are going to create value 10 years down the line. And that's what we look at, right? When we underwrite an apartment building, we're looking at primarily a cash out refinance at year 5 and year 9. Year 9 instead of 10 because we didn't build an 11th year into the spreadsheet. So we had to do 9. So year 5 and 9. And if you overpay for the property, let's just say, in this case, that would have been roughly 5% more. What's 5% less on the back end? But it's also lower cash flow up front. And we were already at a conservative LTV of 70%, but a higher LTV of 70%. So if we push the property up more, and let's just say it didn't appraise quite at that, and we were under contract, then we might have to bring more cash to the table. It's going to lower cash on cash returns, all of those things, right? So a lot of the value is created up front when you write the offer.
I love this idea to talk about this because I think it's applicable in just about everything. I mean, obviously to real estate, but this was something that, like, I guess a lesson that I learned early on and heard. I've heard it phrased multiple times throughout my life that you make your money when you buy, and that's completely true. And I think it's intuitive, but also at the same time, it's easy to forget about, right? And you get kind of caught up in the deal and in some other, or the heat of the deal, or just wanting to get something done, and you get caught up in all the other stuff that
you have capital you either need to deploy, you are truly caught in the middle of a 1031 exchange.
Yep.
Any of those things.
Yep. And I mean, I learned, like I said, I learned this growing up. My dad always liked to flip cars, and not at any meaningful scale, but
just a couple. You rolled them off the side of the road, or
no. We would only do that for insurance purposes every now and then. Yeah.
Gotcha.
Yeah. So any of the insurance adjusters listening to this, you just ignore that. We've never done that. There actually is. There's a spot up in the mountains here in Greene County that is known as in East Tennessee parlance, Insurance Holler. And it's because it's a very, very steep area in a very, very remote part, and people would roll their cars off and be like, I don't know, I guess it got stolen. Anyway, that's I'm sure every rural area has a place like that. But no, he would like to flip cars, and he would always be on the lookout for a deal, right? And with him being in retail lending, he dealt with car values a lot, saw things, so he could like identify something. Like if he saw something for sale, he could generally know pretty quick, hey, this is a deal. Which I think that's probably a lesson in and of itself about knowing your market, and the more you know, the quicker you can identify things and jump on them. But I definitely watched my dad do that growing up, and it never anything that like required a lot of mechanical work, right? It's just okay, maybe they're in a tough spot and they need to sell super quick, and they just don't care. Like, I've got to sell it. I don't care if it's at the NADA or the book rate or Kelley Blue Book or whatever. Either that or someone died and the family's trying to sell off a car. Maybe the car's fine, but it just needs a little bit of cleanup. Anyway, that he would always look for those opportunities, and it was never so much about what it would sell for, right? It like you had to know that, but at the same time, the number that mattered more was, what are we going to buy it at? And because the money's made on the buy. And that holds true for whether you're flipping cars or flipping real estate, right? And Adam, I think to your point, it was interesting. Like, it's interesting in a spreadsheet of all the levers that you can pull, that acquisition price is one of the biggest ones. Right? Like that has a huge impact on everything else. Now, what's interesting in commercial real estate is you can tweak some levers, and you do a lot more spreadsheet engineering, particularly on the exit value. And you can make that number appear significantly larger than it might actually be. But even still, if you're buying at too high of a price, it's really, really hard to add value or do something to out earn your way out of that. And this is true for passive investors as well. Like, and you mentioned for someone that's got capital burning a hole in their pocket, like, you got to know if it's a passive deal, like, is the acquisition price a good price? And I don't know. I see a lot of folks that are like, oh, we're buying at a 20% discount, 25% discount to 2022 prices, and it's like,
you're like, well, what's 2022 40% higher than it should have been?
Yeah, exactly. So you have to be able, like, the the real art in this is being able to figure out what true market value is and whether or not you're actually buying below it. So you can't just take the sponsor's word that, oh, we're buying below what it was worth 2 years ago. It's like, well, okay, you're buying it actually what it's worth today. It's not buying it like a discount to today's prices. But still, point being, like, that's a big part in all of the things that you have to evaluate with any kind of passive deal. Does the acquisition price make sense? Like, is there, if there's some value add upside, is that there? But then how does that compare to what you're coming in at? Because if you're not buying at a discount to market, it's really, really hard to out earn overpaying.
And I think you can, the discount to market could be the value add, right? Sure. It could be that you're doing such and such, and it will increase the value of the building or the asset. I think a good example of that is our oil deal, right? To take it completely outside of real estate, is that, you go and we buy existing production oil, but then we add value to it by increasing the production through drilling new wells. And that is the upside potential, right? Otherwise, if you just look at that, it's a cash flow play, which is fine, but you need to understand what the terminal value is going to be when you sell it. And it's the same on apartment buildings, a flip, a car, whatever it is. I think, and that's not just say, 5% difference, right? Because realistically, we probably could have paid 5% more for that building and been fine, but we also, could have been a bad spot. I think it's more so the knowing that the price you're doing with all the other levers kind of being equal, that you can project reasonably that you're going to be able to execute on your plan, right? And maybe have a little bit of buffer. And that's not to say that everything should be below market purchase price, right? Because it's going to be really hard to find a bunch of off-market crazy deals, right? Waiting for the unicorn, you're going to keep waiting. They don't exist. But finding the property or the deal that makes sense from all lenses, right? I think we offered $1 million over what that building was worth, the one we just got second place on.
Yeah.
And we were comfortable doing that because all the other numbers made sense. There was enough value add. There was enough expertise in the market. We had good enough debt rates. There was a big 1031 going into it. I mean, all of those things helped. And we did go up, right? We wanted like 11.2, 11.3, and we went to 11.5 just to make it a round number. A few $100,000 isn't going to break a $10 million deal.
Yeah.
But it doesn't mean you should just keep pushing. It doesn't mean that the extra million and a half's not going to break the deal. It's got to be within reason. I think it's a little bit of a judgment call. Like you said, your dad knew the values quick enough to be able to go off the back of his head and say yes or no. And similar to the flip that I'm doing, right now, is that I walked in there, knew the purchase price, knew roughly the price of things selling in the market, and knew that there was not going to be a massive amount of work. I mean, don't get me wrong, it was a lot of work, but there wasn't a roof that needed to get replaced. It wasn't replacing all the plumbing, right? The building wasn't too old. All of those things that you just kind of need to intuitively know. And does it, kind of a gut check almost. So I think really what this turns into is just being able to have a decent gut check on, does the things make sense? Is it a realistic purchase price, off of your understanding of the market? If you don't know the cap rate for the market, Google it'll get you close enough, right? Are you within a ballpark range? And I think really all of it comes back to, does the business plan make sense? Because everyone that we know that's super successful wasn't in the short term, buy and flip. Or actually, I'm going to change that. Something I said earlier thought of earlier when I was talking was that every deal is a flip, right? It might not be a 60-day flip, but it's probably a flip within the next 30 years. You will probably sell it. And so what is that exit play? What is that terminal value? And do you think that there is an exit at some point? And if you think, if you buy it today and you're happy holding it, you think you can refinance the debt at that 5-year, 7-year mark whenever it comes due, if that you're safe with that and you're happy holding it for 30 years, maybe you can pay $1 million or $2 million more. Maybe something, you're willing to do it.
Yeah, and that's a good point too. I mean, there was a piece of land here in Greene County that we bought back in 21, and I mean, I knew at the time we overpaid for it. The values have gone up so much that it's not looking so bad now. But I intend to build a house on it, and I intend to live there for a long time. And so, I mean, if I was like looking to execute some kind of business return on that land, I overpaid. But at the same time, it aligned, like the price that I paid aligned with my objectives for it, which is that I don't plan to sell it, and it at that point almost what you pay doesn't matter as long as you can afford it. And it's like, okay, this makes sense. So you're exactly right. Like there's got to be that alignment there, and which is big too, right? Like I think you mentioned this, like we were on this 100-unit building. Yeah. I mean, we did the math, and we kind of, at least to the broker, we came in and said, here's why your building's not worth what you want, but, or, the list price. But at the same time, it made sense for our business plan, and we saw the upside. And so there's different ways to go about it. And I think another important thing too, that we watch out for, and I have to be mindful of this with anytime we're looking at deals, especially if it's a deal with a broker, we can be willing to overpay a bit if we feel like the upside is there because the value potential is there. But at the same time, we have to balance that with, you get brokers who want to price something as though the value add has already been completed, right? They'll price something based on, here's pro forma what it's worth. It's like, okay, well that's nice.
In this case, they just took $160,000 off the expenses.
Yeah. They just, it's nice when you start deleting items from the L side of the P&L, right? Like it's that you can make the numbers look pretty good that way. But that was something I had a mentor very, very early on in this business say, well, it's nice that there's this upside, but you're not going to pay the seller for that if they haven't done the work. And so that, I think that directly ties into this idea of whatever the going in price, especially if you're looking at this from a passive investor's point of view, you got to make sure that the business plan and that purchase price align, and that the sponsor is not either intentionally or inadvertently overpaying for work that hasn't been done. Because that's something we have to be very mindful of, right? Like, and that's tough too when you're dealing with a seller, and from our side, it's like, well, you could do this, and the market rents can actually be here. It's like,
yeah, but your rents are here.
Yeah, it's like, but they're not. So I can't pay you for work that hasn't been done, right? Like that doesn't work in other aspects of life. Like I'm not going to overpay for a building because it could be worth something else, unless that upside is just so tremendous. And again, there's nuance to this. Like we said, we maybe paid $1 million over what the building was truly worth, but at the same time, the upside was so much greater than that we were okay to do it and have a little bit more competitive offer.
Yep. Anything else you want to touch on this?
I don't know. I think this is it's simple, but something, again, definitely to keep in mind. Whether you're investing passively or investing actively, or you're looking to flip cars or whatever it is, the money's made on the buy. And if that going in price is wrong, it can tank pretty much anything else that happens in the rest of the deal.
100%.
Well, Adam, if you don't have anything else, we'll get on out of here for this one.
Call it a wrap.
All right. Well, everybody, we appreciate you listening. Thanks as always, and we'll see you on the next one. And just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.